Hey, 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 welcome in. Welcome in. It
Hey,
is
we
Bill and
are
Brian.
live today.
We are live and
I'm
listen,
Ron Burgundy. You stay classy, San Diego.
stay classy. So we're here to talk about is the bull back in the room and whether or not the energy markets
Show me the money!
Exactly.
so listen, we're going to get started, and we've got a little bit that we're just going to discuss. We're not going to keep here super long, but we are going to talk about the markets. We're going to talk about crude oil. We're going to talk about natural gas. And we are going to talk about are the bulls back in the room? So before we dive into that, Bill, what are your thoughts on are the bulls back in the room?
I think the Bulls are trying to be back in the room, and crude oil is always tough because there's just so many things moving around. And but I have that ADD because I was wondering just now. I said, I wonder why they call it crude oil. I mean, civilized oil. So I think in the civilized oil that it's probably more flat than bullish. But I think we're going to see the Bulls try to push. The
Yeah.
question will be, I mean, we've always, Brian, when you and I have always talked about price. We know at a certain price, things are going to move, so they're not going to move. We know the producers in the Permian have a break even price.
Hmm.
And right now, the Permian seems to be driving everything, both gas and crude oil.
Hmm.
And if that crude shuts down, prices will go up, then they'll come back. And we've played this game our whole careers.
Yep.
It's all about how long, and how sustainable is the price. The other thing that we very seldom know is where the hedging positions are for major producers. If they're hedged at $75, they're going to produce. If they're hedged at $65, they're probably not.
Right.
Um, so, I mean, so when the bulls come in, when we talk about the outside forces, so this is where the fundamentals, crude oil has an interesting relationship with financial and fundamentals because the fundamentals are basically played offshore and the financials are played onshore. And so I think those are the things that sometimes that we have to take in it. All that said, I think the Bulls are back in the room. I just don't know what their longevity is,
Yep.
and the geopolitics are beginning to affect that more and more.
Yep. Yep. And hey, Shansful. Hey, Shanful. Apologies if I got that wrong. But listen, welcome in. Thanks so much. If
So
you have
D, you got
comments,
it wrong.
I'm guarantee I got it wrong. So my apologies. My apologies. I will continue to try. So listen, my apologies. If you have comments or questions along the way, we are live, so we will answer them as they come in. So feel free to post them out there. And as Bill was talking about crude oil and natural gas, we're going to break it down into two segments. We're going to talk about each commodity and we're going to talk about what is ahead of us. And first, we always start with taking a look at where we are. So when we look at where we are, natural gas has traveled all the way down from this low $3 range back up to 375. There's a couple of reasons why. We're not going to talk about the reasons quite yet. And then crude oil has traveled from this key dropping point to 57 all the way to 63.80. But as you can see, it's kind of bouncing between these two technical levels. So that is something to look at. But let's also take a quick look at the forwards because these are kind of interesting when you get into the forward markets. When you look at crude oil, you have a very flat outlook from 2025 to 2030. Now, this used to look like this, which meant the highest price was in the front month and the lowest or front year, and the lowest price was in the far year. Now, natural gas is actually having some interesting things going on to where um, there is a lot of support for for natural gas going into 2025 and 2026. There's some reasons why. We're going to touch on those. We're not going to do a deep dive on each commodity, but what we're going to do is we're going to touch on both of them and really address the question of, are the bulls back in the room? Because there's a big question. Last year, crude was at 80. This year, it's at 60. Last year, natural gas at this time frame was probably $2.10, and we're now at 375. So the worlds have shifted a little bit, and there's a lot of reasons why. We're not going to talk too much about the past. We're going to talk about where we are and where we're going into the future. So,
Hey, Brian, on that futures chart with the crude oil, I think it should be noted that actually the front months are the ones that have slid back. I think if we go back a while, even 2030 and those were out in, they're probably pretty close to the same range they were in. But the reason the shape has changed is because the front 2 years have slid off.
well, you can look at it right here that the front 3 months is really, you can see a different shape for 2026 and 2027. These
Right.
these forward months used to look like this. So what that means is that there's actually some concern for supply in the long term, and there's reasons why. There's fundamental reasons why. We're going to touch on that. But energy roads are at a crossroads. So the oil market overview, the current state, oil prices are very volatile, and amidst competing forces, market participants remain cautiously optimistic. And on the supply demand balance, we're pretty close to balanced. Let's put it this way: a 1% shift in supply or a 1% shift in demand probably equates to $20 on crude oil. Would you agree with that, Bill? And I'm talking
I'm
global
not sure I'd
markets.
go.
Global
Yeah,
markets.
no, I'm not sure I'd go full $20. I'd go at least $10 though. So
Okay,
I'd put somewhere
between
between the
10 to
10 and 20 range
$20. And
for a
so it's
1%. For a 1%. So and what's interesting about that is that at 1% it's at 10 to 20, but you go to 3% and it's significant. It can be $30 easily.
yeah.
I mean, if we lost if 3% of the supply went away, we see a significant change in the price.
Right. Right.
You're talking about reshuffling of oil supply. That would be a reshuffling. And
Yeah.
realize that there's very few people who can make that percentage change. On the supply side, it's Saudi Arabia and the US. On the demand side, it's India and China.
Yeah. Yeah. Well, and you know what's fascinating is I'm working on a presentation about natural gas, and there is a image, and I don't have it ready for this because it's for a different presentation, but it was 2100. So the projection was for 2100. When we look at the population shift, Asia will be in decline between now and 2100 or 75 years, the next 75 years. Africa is going to increase the global population
Right.
massively. So we are talking about a massive shift in energy supplies from production, because you have countries like Nigeria. We were on a call yesterday to James at Arcus FX. If you're listening, hey James, and he was telling us about an LNG project.
No, I like that guy.
Oh, I love that guy. He's a phenomenal technical trader. We focus on the fundamentals over here. We do touch on technicals, but James at Arcus FX is probably one of the top technicians that I have ever seen, and I've been on trading floors at multinational companies before.
Yeah, and on top
So
of that, he's a pretty cool guy.
he's an amazingly cool guy, and he's just a nice human. So anyhow, when we're looking at these projections, the energy flows of where supply comes from, where demand is being consuming, and now consumption on crude oil gets a little nuanced because some people call that a consumption into a refinery. Well, that's not the ultimate consumption. A refinery is a
No.
processing
No.
to final fuels that can be used, such as gasoline, such as diesel, such as jet fuel, such as other
Motor oil.
products, lubricants, all kinds of things. And then it can break it down even further into products that are used for plastics, for fibers, and all kinds of things. So let's pull back and take a look at the oil market forces. Let's look at the bullish factors and the bearish factors.
So by the way, you talking about 2100? Is that what I hear you say? You said 75 years
Yeah.
from now?
Next 75 years.
I think I'll have my student. I think I have my student loans paid off by then.
I think that's probably most everybody on the call right now. So
we can hope, right?
yeah, exactly. And a lot of times when college graduates graduate, all they hear
Pick up the phone and start dialing.
That's what colleges college graduates get a stark reality. At least I did. So let's look at the bullish factors. The bullish factors is production is stalling in non-OPEC plus countries. So when you look at non-OPEC plus countries, I'm mainly going to talk about the United States because they have been a significant supplier and one of the and actually the largest gas exporting country in the world. That's another fact. Edging out Russia, edging out Qatar, edging out Australia, and by
Australia.
edging out, this is not by a small margin. So, but production is stalling here, and the main driver is at $60 crude. You are not going to have much drilling, and it's part of the reason that when we look at the state of the market, one of our key charts that we tend to look at all the time, and we talk about is this is crude oil net production in the United States. So what you can see on this chart is that back in early, mid 2024, we were adding 70,000 barrels a day of new production every single month. And we're now down to about 40. We did tick up month over month from March to April. The May numbers haven't been released yet, but that's what we're seeing on crude oil. So you can think about it this way: 13.5 million barrels of crude are produced in the United States. We are adding 40,000 barrels a day to that each month. So that's just a drop in the bucket. Meanwhile, gas.
Yeah, but in order to add that 40,000, how many new barrels do we have to bring on?
Roughly 700,000 barrels a day of new production. So it's a 10-to-1 ratio right now, roughly. I'm rounding off, but natural gas is in net decline. Now, the week-to-week, day-to-day numbers are going to look different. This is taking a holistic approach of looking at declines, production declines, and new additions to natural gas. And to follow that same suit, out of 104 BCF a day every month, we decline by over 3.5 BCF a day. That means we need over 3.5 BCF a day to add production. And what this chart is saying is that we're not making that mark. New production is falling short of 3.5 BCF a day each month of new production. So, but production is stalling. And what that means is the United States on the crude oil side is not going to be a big contributor. Canada has been adding some, but at $60 crude, there's a lot of economic upwinds. There has been
Canadian crude has a high lift cost as well.
Yes, they
do.
do.
Tar sands have a high lift cost.
Do you know what percentage the tar sands is of Canadian production?
I do not know what their breakdown is, but I know
it's significant, but I just don't know what percentage.
I think it's what increased their production. We'll figure that out and get back to you guys.
Yeah. Or if you know, drop it in the comments. Um, we do have resilient demand despite economic concerns, a lot of the tariffs, trade wars, and turmoil that we've had on the geopolitical front has created a lot of concern around demand. And demand has been resilient to date, but it not really showing much growth. And we'll talk about that in the bearish factors. There are potential supply disruptions in key regions. You can look at it this way. Over the weekend, Ukraine struck Russia, and they are attacking energy infrastructure. So this is this can get very volatile very quick. The last time that energy infrastructure was targeted by Ukraine, Russia was able to pivot and get things back online pretty quickly. However, that means that the oil markets are on edge. So there's a lot of potential supply disruptions in the region. Now, any other comments
58,
on the
58%, Brian. 58% of Canada's
Okay.
toxic.
All right. So yeah, significant. On the bears factors, there are weak Chinese economic indicators not showing much growth. It's kind of plateauing. We
Yeah,
do
I always take that, by the way, I take that with a grain of salt because not only do we get bad information out of China, we get unreliable information out of China. So
Mm,
most of that
mhm,
is based on shipping and
mhm.
their exports and what we're seeing coming off of there. And so China likes to play a lot of different games. Like when the crude oil's low, they'll buy it because they have a lot of storage.
Right.
And we don't have access to those storage numbers, but they have a lot of storage, and so they'll put a lot of it in storage. But I think there's two things going on this, and I hesitate to do this, but right now I'm going to agree right now with um, our good friend who does all the uh, population uh, numbers, and saying that I think we don't really understand China's population yet.
Yep.
I think because we're trying to believe the numbers out of their government, and it's not true. In fact, there's an Peter Zion is talking about how their numbers could be off by 100 million people. That's pretty significant,
Yep.
and that could easily, instead of saying it's weak economic factors, maybe their demand's really where it should be. We're just dividing it by the bottom number. We're using the wrong denominator
Yeah.
when we're trying to figure out what their demand is. And so I'm going to say weak Chinese demand could be the fact that we think that it should be higher than it really is. And so maybe they're growing at the right rate. But we say that to say this is that we're not seeing a significant amount of increase in that demand based on the economics that are happening there. Um, I still like watching that guy. What's going on with shipping? That's sort of where I look for Chinese demand is on container ships, and he watches it
Mhm.
really good. And so we've seen. I didn't know this. 90% of the containers are controlled by Chinese.
I could believe that.
That's a
I could
big
believe that.
number. That
Yeah.
is a big number. Okay.
Yeah.
So all I'm saying is on the weakness in the economic indicators. That's why that one gets real hard because all the numbers are not as firm as what we get in the West.
Right. There's a little bit of guesswork, or maybe a lot of it. And let's see, for Shanful, I'm going to break it into two. Natural gas targets price range. We are going to get to that. It's going to be a few minutes down the road because we want to finish out crude oil before we get to that. So it is going to be towards the end. I will give you a quick preview in that right now, when I look at natural gas from a technical perspective, there's two levels to watch. One is down here, which is between $3 and $3.12, and the other is above and between 417 and 396. We have broken into a range. Oh, and there's a short-term one right here. So short-term, I would expect a retracement back down. However, that gets into some of the market forces that we're going to talk about on natural gas. So when we get there, we will talk about that. But the the bearish factors on crude oil over 2 million barrels a day are still offline from OPEC Plus, even though there's been two increases. This could add, and I think if I'm matching up what OPEC Plus and their policy is going to target, I think they're trying to match some of the declines or some of the failing additions in non-OPEC Plus countries. So I think they're just measuring that out, and it's the reason that they only brought on 411,000 in July. So that is the guidance, and that's what they're expecting. And that combined with the increased Russia-Ukraine tension is adding a little bit of support, not a lot. But there is still some potential for demand destruction from the high prices from last year, believe it or not. The high prices and inflation that we've encountered over the last 2.5, 3 years. So there's a little bit of demand destruction in that when things are flowing, everybody is spending, the economy's good, everything is going, but now it's a key question mark. So let's get
I
into
think part of the
natural.
demand destruction too, when it comes to gasoline, is that we're seeing higher efficiency vehicles, so they're not burning as much. Even though we have the same amount of vehicles, not more vehicles, they're not burning as much. I think also what we're seeing is the diesel. When it comes to the economy, what you see is how it hits this is that the diesel trucks stop moving.
Right.
So you're losing on bunker fuel, shipping on the U.S. or shipping on seas, and transportation. Less trucks moving, they're the ones burning the diesel. So that's where you see the economy come in to affect the oil price. And that's the demand part that they look at. So I think what we're seeing is a little bit of efficiency and some a little bit of recessionary activity.
Yeah. Well, and that all factors into the equation.
You see that there? I just made up a word.
I like that. I like that.
Bill's
don't
dictionary.
care.
It's another chance to use the BS of BS. There we go.
Yeah. All right. So let's look at natural gas. The bullish drivers. Associated gas is likely to fall, and this is part of the reason that we look at this chart very closely. When we look at Permian, Permian is where most of the associated gas is coming from. Our net additions are just shy of 200,000 a day adding. And if I look at every other basin, let's add these back in, we are in net decline. And these decline numbers are close to 350,000 decatherms a day. So when we look at that, Permian is the only region that is adding, and that is because of associated gas, which is gas that is produced alongside crude oil. And that's projected to drop because there's reduced drilling for crude oil at $60 a barrel or 65.
And it's important to note that the reason that that's strictly based on the crude oil price, we have so much natural gas right now. When that gas gets to a $4.50 to $5 price, we start seeing some of these dry gas basins open up. We're just not seeing that now because the price is too low for them to bring in the big gas, out of the Haynesville. I mean, there's so much gas out there right now. We can go a long way, and we're just really starting to find it. So
Right.
our natural gas, the price on natural gas is what's going to drive the natural gas development. And as long as if it's below $4, you're not going to see those big reserves open up that much. You'll see some replacement, but that's about it.
Yeah. So associated gas is likely to decline, reduced Canadian imports, and this is a key factor that we're looking at into 2025 because there's two factors. Right now, there's Canadian wildfires. Canadian wildfires is threatening production. And so as that threatens production, we are going to have fewer Canadian imports. But another factor, and look at this, back in early January, we were up to 9 BCF a day. We've built back some and gotten close to 7, but there is an LNG project called Kitimat, and the Kitimat is going to be on the western side of Canada. That is coming,
Right.
and that is going to reduce the amount of gas that the U.S. gets via imports. That's probably likely to drive up California prices significantly, because there's going to be less coming down over there, because it's all going to be going out on ship, because the economics are there for LNG. And there's potential weather-driven demand spikes as we get into heat and as we get into the summer season. Last summer set new power records. And the question that we'll talk about in the bearish pressures are they going to continue? So on the bearish pressures, near-term numbers are showing power and LNG showing a lot of weakness. So this move up to 370, 375 from a fundamental basis right now is very befuddling, given that there's bearish fundamentals right now. There are bearish fundamentals, there's some heat coming out, and I think this might be fear around Canadian wildfires. And Sabine Pass does have some maintenance that is going to last for several weeks. That is going to add in another B to 2 BCF a day back into the U.S. grid.
And I think that's something people are not calculating into their numbers, is that every one of these LNG plants will have downtimes. You can't just look at their max capacity and show it flat for over the years. Even if they had the demand, they do have to shut down and do maintenance. And so this is a little bit different than what we usually look in a gas demand. In fact, there should be some sort of variable put into our forecast that says, hey, listen, they are going to go down. It's not like if they're going to go down, it's going to be when they go down. So the Sabine Pass, it was scheduled. There was a schedule out there for when it was going to go down, how long it's going to last, and when it comes back up. Their supplies and their markets understand this, and that's where they start to see that. And so we just need to understand that 20% of our exports, or 20% of our total production going to exports right now, all that 20% is going to have this variability in it because of mechanical issues.
Right. Yeah. That's definitely true. Near term.
So if you're showing LNG flat, when somebody starts showing an LNG flat curve, yeah.
Well,
it's not going to be that way.
Again, when we look at the demand side, we track this on a weekly chart, and when we look at LNG and power, these are two of the key drivers. And one of the key concerns that I have right now on the power side is this dip. All these other dips have been increasing, and this dip down here, part of it is weather, but part of it is wind and renewables. So part of that dip could that be a canary in the coal mine? So, and then when you flip and take a look at LNG, we have had pretty solid growth, but we've kind of plateaued here. Our operational capacity for those on the line is somewhere up here. It's closer to 18. So the fact is, we aren't exporting everything that we're capable of. And now some of it is maintenance, some of it is international markets, because the US, despite exporting a lot of LNG, is still more expensive than other alternatives such as Qatar and Australia. And that has to do with the distance between Europe and the United States, and Asia and the United States. So we are having a disappointing start to the summer demand season. Demand hadn't shown up. I live in Colorado, and my furnace kicked on this morning. So we're in a weird place right now. Storage levels
Right.
are remaining above seasonal averages. So the market sentiment is there's growing concern about supply. However, the supply is really on the bullish side because we don't expect production to increase. However, Canadian imports are likely to decline, but it's really going to be about power and LNG. And that is part of the reason we created Energy Rogue, which at the beginning of every week you get a video alongside our Monday game plan, which gives you a narrative around how to set up for the week, and Rogue Radar, which gives you a convenient red light, green light for every factor covering natural gas and covering crude oil. And then right next to that is our new natural gas radar that is published every single day, that has a technical analysis, breakdown, fundamental analysis that tells you all of these things to watch. Where are we on the current week? Where were we last week, last year, and 3 years? Weather analysis, economic analysis, CFTC reports that you can tell whether or not there is some managed money. Right now is bearish and strengthening. So that is actually on the crude oil side, it's bullish but weakening. So this is important stuff to know, as well as LNG market analysis, news and sentiment, and Fibonacci levels. This is basically if you're trading the commodities or you're hedging the commodities, producing and selling the commodities, or consuming the commodities, and I'm talking about natural gas, I'm talking about crude oil, I am talking about heating oil, distillates, diesel, gasoline. This is information that you need to know. You can find it out there, or you can sign up to Rogue Radar. It's $89 a month. There's a link down below. And we do the same thing on crude oil as well, where we actually break up OPEC analysis on the recent OPEC reports. What is actually happening out in the marketplace? So these are things that you need to know. And when we're breaking down these bullish and bearish pressures, they come from those reports. That's where we're getting these, so that we look at the associated gas, we look at the power, LNG, and you can see it right here when we look at natural gas. Let's take the power and LNG and why that's concerning. The LNG exports, 15.7 last week was 15.6. 3-year average was 12.8, but this upcoming week is going to be below that. Then you can look at the electric power demand. We are right at our 3-year average, but we're way below last week and way below last year. So that's the reason that we put power and LNG in full focus about the sentiment. So summing up, the key market indicators to watch are going to be OPEC plus policy decisions, plus the news of the
Is
day,
always
the
what we watch, right?
geopolitics, Peter Zion, all of it matters. You need to consume as much as you can on news and whatnot.
So
Non-OPEC.
Brian, let's talk real quick. Who do you watch?
I
Who do
watch
you think are
Gulf Intelligence, the daily energy markets podcast. I'm
okay?
on there sometimes. Every day that gives me a digest of what is happening around the globe
Right,
for
the international perspective. That's why you watch that.
US markets. I actually look at our crude radar, which actually grabs the latest news and analysis and gives me a sentiment. So I actually, in addition to what is happening on the Gulf Intelligence podcast, this right here, this links me out to various articles, such as oil rises as OPEC plus confirms steady production increase. Those are the
Which,
two
by the way,
factors.
let's talk about that. That sentence in itself is an oxymoron.
It completely is. It completely is.
So when you see that, now you have to go and look why.
Yep.
That's always the question that you have when you're looking at this stuff, is that you see that and you go, well, that doesn't make sense. Why is it
Right.
doing that?
Yeah. Yeah. You're
Okay.
exactly
So
right.
that's two. Give me one more that you look at.
And then for natural gas, I look at our radar every day. I don't look at anything else because it's too many different places to look. In the space for technicals, I watch James at Arcus FX, and that's
Mhm.
outside of that. I look at our Rogue Radar because it gives me everything that I want to know in condensed fashion, and it puts it in a 5-minute read to where I can scan it, and I can go deeper if I want to get deeper. But those are the
So how
three
many sources
sources.
how many sources are we hitting with our Rogue Radar? How many would you
Um,
say that we go out and pull every day? 50?
No, it's probably, well, it depends on the news articles. I think it's less than 50, but it's a significant number of sources. So, because we have different data sources, some of it is EIA, some of it is OPEC, some of it is state companies, Baker Hughes. You look at EIA, IEA, then you look at various news sources such as Reuters, Bloomberg, so on and so forth. And yeah, Joe, James is great. He breaks it down in a very condensed fashion. And that's what I really enjoy. And we just talked with him yesterday. We got some things brewing, so stay tuned for that. So
I think it's important to note, folks, is that what Brian says, he looked at 3 or 4 things, but the reason he can look at 3 or 4 things is because in the Rogue Radar, we're looking at a lot more.
right. Yep.
And that's why you need to be involved and be subscribed to Rogue Radar,
Yep.
because it can take all that stuff you're looking at and bring it in short, and then you can go out and look for those. I call them the one-offs. See, I consider Peter Zion a one-off because he's bringing information that I would not necessarily go look for.
Oh
And
yeah,
so,
definitely.
you know, and so those are the kind of one-offs that I'm looking for. I think there are a few others that I look at. Robert Bryce is a good one I look at, uh, and because he's actually looking at different things. But overall, if you can't find it in Rogue Radar, I mean, Rogue Radar should be where you start, and then from there develop from on out, because the Rogue Radar has already done and gone to look at all the basic stuff for you, brought it in, even some perspectives that you wouldn't normally get in your circle of friends. And so what we do is we try to do that out. Now, Brian and I've got contacts all over the industry, and every now and then when we have something very specific we're looking for, we have anywhere between 10 to 50 people we can call about it and know those specific answers. But when you're looking for something somewhere to start, this should be your starting point. Rogue Radar is has that broad a reach to be able
Yep.
to do that.
Yep. Yep. And plus it condenses all the technicals and Fibonacci levels. It even has a machine learning price prediction, which this ran at midnight. It was projecting that we would go to 375. Let's see how it did today. It fell short. So we have not fallen short. So this is part of the reason that we have natural gas radar, crude radar that is driven by some of AI. And this is the reason that we have the latest video with the Monday game plan with the Rogue Radar, because this is written from the human perspective. So we bring in human and AI because it's not just about AI. It's not, there's a lot of human nuance, and that's part of the reason James at Arcus FX brings in the human on some of the technicals.
And don't forget our secret weapon. Brendan's our secret weapon.
Yes, he is. Yes, he is. So we need to talk to him. We hadn't talked to him in a while because we have to get an update on summer.
Right.
So I'm going to leave you with 4 things to watch. OPEC plus policy decisions, non-OPEC plus production trends, which we track every day. It's inside of crude rogue radar. LNG and power demand on the gas side, plus Canadian imports on the gas side. So those are the 4 things to watch for and to really discern, are the bulls back in the room? And if you believe they are, it's probably because of OPEC plus policy decisions or non-OPEC plus production trends. Because right now, I think the economic climate is really just stable but stagnant, not really growing, not really declining. So that's where
I
we
think the
are.
only thing that I
in
would
crude
add
oil.
to that, Brian, I think I would add to that I would look at refinery margins. That would be the other place I'd look.
Yep.
It's often
And
overlooked.
it very much is, and that's part of the reason we track this crack spread every single day. So you can see it from here and what we went from and to from 2022 when crack spreads were $60. Of course, 2022 we were at $100+ and we're now down at a $60. So think about that. We're at a $60 crude, but our crack spreads are still about $22. So that's pretty interesting to me. So that means that there's definitely something to be said for that. So anyway, thanks so much for joining us. Oh, I do want to circle back to one other thing, which is the price levels on gas. What I'm watching for right here is, since we have failed at the 375, is if it thrusts back above, it really should go to this 387. But if it fails again here, we are going to go down probably at least to 324 and then likely to $3. So that's actually what I'm seeing. And the fundamentals are aligned on that. But this push has been technical and nature. And part of the reason that we know this is because of the CFTC
You don't
commitment
have
of
to get better
traders.
at the video. That's not a good picture of you.
Well, that was on the road. That was on the road.
Yeah.
That was on the road. So, but look at this. The managed money is bearish and strengthening, meaning they're adding to shorts. So I would be very much ready, because I think there's going to be a lot of this drive up from 350 to 375 was some short covering, and based upon the fear of Canadian imports. So
It looked
I
like it
think
could
that's
stop there
going
at
to
that
dry up.
344 when you had that up there. It looked like it'd stop at that 344. At
That's
least
going to be a
like
kind
50
of a
bucks.
key anchor. I think that's a key anchor for the rest of the summer, really.
Yeah.
So that's kind of what I'm saying. So listen, folks, thanks so much. Really appreciate you watching. If you're curious, you want to learn a little bit more about Energy Rogue, there's links down below. And listen, we're excited to have you here. So thanks so much for showing up. Do drop a comment. Let us know what you're thinking, what you're seeing out in the marketplace. We told you what we're watching and the key factors that we're watching that'll tell us where the future is. So any closing words, Bill?
I think it's important. We're in that volatility period. We are probably on natural gas. We're weak for the first week of June. We usually see a little bit stronger demand right now, and so I think the weather has been driving that. So when we look at the fundamentals, we combine the fundamentals with the technicals and try to figure out what the variable is in that. So, hey guys, have a great start to your summer. Come see us again next week, and there's only one word I think we really need to say, Brian. Subscribe.
So we hope to see you inside, and until next week, we'll see you then. So thanks so much. Have a great rest of the week.